It's always sensational news when central banks raise their interest rates. In recent weeks, we have seen banks raise interest rates because they believe that the only way to try to control inflation is to raise interest rates, which in turn raises the costs of borrowing. It has the potential to reverberate throughout the economy and has the potential to undermine consumer confidence, resulting in fewer jobs and reduced salaries, and cause stock prices to fall. They can nudge economies into recession if they go too far too fast. So why are central banks increasing interest rates? Let's start with the fundamentals. When you borrow money, you'll have to pay a little extra to make it profitable for the lender. Banks will assume that you can get a loan because you have a great reputation and appear to be reliable. They discuss the interest rate with you, and you obviously want it to be as low as possible so you don't have to pay too much back. On the other hand, if you want to save money, a high interest rate means you can earn more money. Consider it a reward for keeping money in your account. However, the size of your reward will be determined by the circumstances. In the economy, there is no single interest rate. There are thousands of banks that set their own business rates. However, all of this is influenced by the interest rate set by the central bank. A central bank functions similarly like a bank for banks. Banks like you and your savings account earn interest when they deposit funds with the central bank. Reserves are assets held by commercial banks. That's similar to their cash on hand. Commercial banks can lend their excess reserves to one another at interest, and they can also deposit their excess reserves with the central bank. And by doing so, they can earn an interest rate. Ordinary people cannot access the interest rate on excess reserves, but it affects them nonetheless. That is the concept. When central banks raise interest rates, they are attempting to control inflation, or the rate at which prices rise for everyone. Central banks such as the Federal Reserve, the Bank of England, and the European Central Bank are all attempting to meet a 2% inflation target. Interest rates are a very powerful tool that they have. When inflation is deemed excessive, banks raise interest rates. The adjustment spreads throughout the financial system, slowing the rate of inflation. This is how. When a central bank raises interest rates, commercial banks earn more on their reserves. They may make more money by keeping their funds in a central bank rather than lending it out. So if they do lend it out, they will raise their interest rates to make it worthwhile for them to do so. The economy will determine how this affects consumers. Consider mortgages in countries like Australia or Finland. Many people have adjustable rate mortgages. If you have an adjustable rate mortgage where the interest rate you pay is connected to the central bank's interest rate, high interest rates mean that you will have less cash to spend on other things right away. Households will spend less if they have less spare income, and with less spending, businesses will be more hesitant to raise prices. This should reduce inflation. Fixed-rate mortgages are more common in other countries such as the United States and Canada. People with fixed rates are safe against the immediate impact of an interest rate increase, but will still be affected indirectly. Mortgages will get more expensive as interest rates rise. If this affects all new buyers, house prices will start to fall. As a result, everyone who owns a home will feel poorer, and they may spend less. Lowering spending will result in lower inflation. And it's not only consumers who will have to tighten their purse strings. When interest rates rise, it becomes more expensive for business owners to borrow and invest. In general, this means minimal economic activity. It is possible that fewer jobs will be created as a result. Higher unemployment and lower salaries may result in less money for households, and consumer confidence may suffer as a result. That means less money spent. People are dealing with a drop in real wages, which means their money buys less. When interest rates rise, it tends to slow spending, investment, and overall economic activity. This will make businesses more hesitant to raise their prices, which will tend to slow inflation. It appears simple, doesn't it? The technique is determining how far to go. The Federal Reserve, America's central bank, legally permitted interest rates to reach a record high of 19% in 1981. The move reduced inflation, but it caused widespread economic harm. Unfortunately, we are in the midst of the worst economic crisis since the Great Depression. It is extremely difficult to manage inflation without severely hampering economic growth. In the United States, it has been more than 70 years since inflation fell below 5% without starting a recession. A little inflation is acceptable. It keeps the economy moving at a reasonable pace. However, excessively high inflation is a problem. Higher prices necessitate higher wages for employees, driving up business costs. This could push prices even higher, potentially resulting in a downward spiral of prices and wages. In India, retail inflation has risen to 7.8%. The combination of sluggish economic activities and high inflation poses significant challenges to the Indian economy in the future. Central bankers are very concerned about setting inflation expectations. The idea is that if it can demonstrate that it is legitimate, that it will always act to bring inflation back down to 2%, it may not need to raise then reduce interest rates in this seesaw fashion. Raising interest rates can severely slow an economy. The issue is that the brake pedal has a lag. It can take up to 2 years to see the full impact of interest rate modifications. Central banks are aware of this. When they set interest rates, they are attempting to predict the future. But forecasting the future is difficult. The problem is that the central banks cannot predict whether inflation will fall on its own. Even if the central banks get it right, they could still cause a crash. Although it is a blunt tool, raising interest rates remains the central bank's primary tool for containing inflation. Yes, central bankers would agree. Raising interest rates is excruciating. Slowing the economy is unpleasant. But it's well worth it. It's worth it to achieve low and consistent inflation so that you don't have to worry about it in the long run. What do you think? Let us know in the comments section how you think inflation is impacting you. That's all we have for today. If you'd enjoyed the video, why don't you give us a like and subscribe to our finance channel. Don't forget to hit the bell button below to get notifications on when we'd post next. Thank you for staying till the end of the video and hope you enjoyed. See you next time.